Welcome to Conversations, a weekly audiocast featuring interviews with leading investment strategists and recognized financial professionals. Brought to you by the Market Technicians Association.
This is Conversations, the official MTA Podcast Series, and today's guest is Arthur Hill. Arthur Hill, CMT, has over 15 years' experience as a technical analyst, trader, and educator. Arthur is currently the Senior Technical Analyst at StockCharts.com, a website providing analysis tools, education, and commentary. He has written over 100 in-depth educational articles for their comprehensive chart school. Together with John Murphy, Arthur is co-author of The Market Message at StockCharts.com. In addition to timely analysis, John and Arthur educate chartists on various analytical approaches and intermarket relationships. Prior to joining StockCharts.com, Arthur was a member of the Society of Technical Analysts, STA, in London, where he taught the candlestick and momentum modules for the STA diploma course. His articles have appeared in Stocks and Commodities magazine and on their website, traders.com. Arthur has a BA in Russian Studies from the University of Houston and an MBA in Finance from City University Business School in London. He is a member of the Market Technicians Association and holds the Chartered Market Technicians designation. Welcome to the program, Arthur.
Thanks very much for having me.
So tell me about how you transitioned from Russian studies to the financial markets and technical analysis.
Well, after working in Moscow for 4 years, I decided to return to school and go and get an MBA. And so I enrolled at City University Business School in London, and part of the reason was they have good contacts with the financial industry there. And I rekindled my affinity with technical analysis, and it was there that I joined the Society of Technical Analysts during my MBA program. And after I completed the MBA in 1997, I started trading again and began tdtrader.com. And that was a website offering technical analysis, commentary, and charts. And then TD Trader was acquired by StockCharts.com, and I've been with StockCharts ever since as a senior technical analyst.
So tell me what your go-to indicators and techniques are. What does your technical analysis toolbox look like?
Well, I use a classic top-down approach when I look at the markets, and I'll look at the big trends. I like to use weekly and monthly charts to establish the big trends. I find a 12-month moving average is pretty good when you're looking at the S&P 500, say. And I will even apply some economic indicators. I will chart those and look for the trends because economic indicators do trend. Now, they are going to be lagging somewhat at the turns, at the tops and at the bottoms, but during the majority of the move, they're going to be trending. For example, jobless claims have been trending down since the second half of 2009. And so that is a good sign for the market. So that tells me the path of least resistance. And so once I've done that, I then turn to the sectors. I'm looking for the sector leaders and laggards, and I use 3 tools for that. We have perf charts at stockcharts.com, and they make it really easy to compare the performance of the 9 sector SPDRs over 1, 3, and 6 month time frames. And then we recently added breadth indicators for the sector SPDRs. And so I can look at the 80 line and the 80 volume line for these 9 sectors. And then finally, the third tool for the sectors is the Stock Charts technical rank. And that's a ranking system based on a technical score. We use moving averages, rate of change, and RSI. And so using those 3, I'll get my top sectors, I'll get the sectors to avoid, and then I'll dive into the industry groups to find the strong industry groups, and then, of course, into that to find stocks. And when it comes to picking stocks, I use classic technical analysis. I'm looking for pullback patterns such as falling wedges or falling flags or Fibonacci retracements to get in on an uptrend, so to speak.
Okay, so you use a fundamental backdrop and then you move to the technicals. How do you...
Yes, I'm trying to get the path of least resistance.
Okay. to increase your batting average?
Yes.
How do you said you use a 12-month simple moving average for your long term. How do you measure and define the trend in general?
Well, I look at the direction of that moving average, and I look where the index is relative to that moving average. I mean, if it closes, just below it, I might wait another month to see if it's going to continue and have a decent close, put on a price filter to not get whipsawed. Keep in mind, I'm just looking for the path of least resistance. This isn't a tool I'm using as a timing tool. It's just a tool to tell me which side of the market I want to be on.
Okay. So what do you use for a trigger to say now is the time to be long or be short?
Well, for a trigger tool, I would use something like RSI and look for it to pull back into what I would call a support zone. In Constance Brown's book, Technical Analysis for the Trading Professional, she talked about a system that Andrew Cardwell developed. And basically, he theorized that RSI is in bull ranges and bear ranges, and the bull range is 40 to 60. And the S&P 500 chart worked out really well since mid-November. So it was in bull mode in December, and RSI pulled back to that 40-50 zone in late December, in late February, and mid-April. And each time that was a signal that you had a pullback and to look for a continuation higher. And so you could turn to the price chart and see if there's a flag or if there's some sort of upside catalyst on the price action to put you into a long position.
Now, you recently published a book called Define the Trend and Trade the Trend, How to Identify, Follow, and Time the Trend Using Price Charts. So before we get into that, what was your motivation for writing a book?
Well, I wanted to give novice and intermediate chartists the basic skills to define the trend and define tradable opportunities within that trend. And I wanted it to be relatively simple in that you could visualize it on the chart. You wouldn't need to go into heavy-duty quantitative analysis or run a lot of scans. It's more visually oriented. And the book is 8.5 by 11, so it's a large book because I wanted to use large charts. There's over 100 charts in there with lots of real-world examples of defining the trend and looking for pullbacks, say, within an uptrend to partake with a better risk-to-reward ratio.
And so what should a reader, you said a beginner to intermediate person picking up this book should leave with what tools and skills?
Well, I think a beginner and intermediate chartist would be able to go out and look at a chart, and they would know the trend, so they would know whether they were looking for long positions or short positions or just avoiding the market if it's in a downtrend. So they would know which way they wanted to trade, and then they would know what to look for as far as timing is concerned. A retracement, how far do you want it to retrace? What kind of patterns would you look for? And then when would you know that those patterns are ending? So I show candlestick patterns and gaps and how volume can help you identify the end of a corrective pattern and the signal that the trend is resuming. So that's what these novice and intermediate chartists would get out of this book.
Okay. So as far as indicators, there weren't many indicators in the book. I can recall unbalanced volume, but in general they're chart patterns. But I have seen your work at stockcharts.com over the years, and you are very skilled at taking indicators and using them effectively and oftentimes giving a fresh view of the indicator and how to use it. Is this something that's natural for you to do, or is it more of a learned skill to think out of the proverbial box?
I would say it evolved as analysis skills grew, and the more I looked at charts, because, of course, when I started, I read everything I could get my hands on as far as indicators and technical analysis and the markets were concerned. And you see what the traditional signals are from an indicator. But then when you look at them and you put them into practice, you realize, well, they're not working quite that great, or you could do something different. And this is what I find with a lot of stuff. You know, you want to learn, but sometimes it helps if you approach it from a clean slate and not have that bias in your head before you're looking at something. And so when I'm looking at an indicator, I try to say what would make this indicator more robust in the signals. How would I get fewer whipsaws and signals that lasted longer from it? Mm-hmm. And you don't want to overfit it, but, you know, that's the challenge. Nothing is going to be perfect.
So what does your next book look like? Have you considered what your second, I know this one just came out, so I might be jumping the gun here, but what would you like to write about next?
Well, you have intrigued me because with this question on the indicators, and I think it would be helpful for chartists to have a fresh look at how to look at indicators and to look for different ways to use them. For example, one of them I've used recently is the directional movement indicators. And if you have plus DI and minus DI, and you just use crossovers as your signals, you're going to get whipsawed all over the place. And so what I found is you need to put a threshold on those crossovers. In other words, if plus DI is moving above minus DI, that's positive, but it needs to go above 30 to further qualify that signal, and that will reduce the whipsaws, and that will help you define a trend better. And the same with minus DI. We look for minus DI to cross above plus DI, and then to make that little extra step above 30 to further quantify that signal. So I think I would consider writing a book talking about how to use indicators in a different light. I won't give you a date on the publication, though.
Oh, no, I would. I definitely want to have you on when that one comes out, though. So
okay,
we'll pencil it in.
Don't hold me to
it. No, you also trade your own portfolio, correct?
Yes.
As you think back over, you've been trading long enough. You've seen several business and market cycles. What is one of your more memorable trades?
Well, I'll stick to something recent, and I'll give you a good one and a bad one, because we all know we have bad trades. I mean, it's just going to happen. Even the best-looking setups go awry. But one of them that I really liked was Activision back in November and December, and it had basically two bullish patterns taking shape. There was a double bottom forming in November, December, and then there was a little surge in January. And then just below that double bottom resistance line, you had a little flag. And there was good volume on that surge, and you had that little flag breakout just before the double bottom breakout. So I was able to get in before the double bottom breakout and catch it before it gapped higher in February. So that was a really nice trade.
That's a 30%
but on the flip side, yeah, it was up about 25%. A little bit of luck involved, probably, but you know, Arnold Palmer famously said, "The more I practice, the luckier I get."
Sure.
So I always keep that in mind. And then I had a bad trade in Citrix Systems a month or so later. It had a really nice flag. It had a nice breakout, but it just didn't continue higher, and it gapped down. And when things aren't going your way, it's telling you something. And so I had to get out of that one and take a loss because it moved back below my flag breakout point, and that told me it was failing. So it's important to listen to what the market is telling you, basically, because the market was telling me, hey, you're wrong on this one.
Right. And you hit your pain threshold and got out before it was a 30% loss, right?
Yeah. The key, of course, is that Activision gain can absorb a couple of losses, and so
Right.
the key is to keep those losses manageable so that they don't outstrip your gains.
So you are very well read in the markets. As you look at your market library, what is the most influential book on your shelf?
Well, I'm going to have to go old school on you on this one. The classics I just can't get away from, and I find myself reading them every couple of years, is Reminiscences of a Stock Operator and the Market Wizards series. Those are just great books to get you oriented on your trading psychology, which is a really important part of trading.
What are your takeaways on the Market Wizards books? Because those are classics. I think the original one was in late 80s, right? 1987, 88?
Yeah. Well, I really, when you read how these different traders operate and their different methodologies, they're completely different in a lot of ways. And you'll find a trader that maybe suits your particular style, and that's what I learned about Ed Sikota and his trend-following type of trading. And he's one of the memorable ones that I found in the Market Wizards series. And so I followed him and learned some of his methodologies on trend following. But of course, you have to adjust them to your particular style, and I use more of a, try to say trend following, but I look for that mean reversion in the fact that I'm looking for that pullback pattern or that retracement to get me in with a better risk to reward ratio.
Mm-hmm. Well, I'm looking at the markets today, and the Dow has been off as much as 225 points. So can you give me your view on the market and maybe where we're at?
I think we are entering a corrective period, and it is a bit overdue because, we have been moving quite higher for a long time now. I mean, we've had a huge move up from November 2012 and even from June 2012. But I'm looking for a corrective period using retracements and looking at the March, April lows in the S&P 500. Maybe we could get back to the 1550, 1530 area in some sort of pullback or corrective period that extends. Maybe that'll happen into August, September. And I'm also noticing that there's been a change in the relationship between Treasury yields and stocks. They used to be positively correlated, but now we're seeing yields shoot higher and stocks move lower. And so stocks are making an adjustment. And, when I look at the 10-year Treasury yield chart, we're at 2.4%. Well, if you go back to early 2011, we were trading above 3%. And in the summer of 2011, July, August, was when all hell broke loose in the markets. And that's when the Treasury yield plunged from 3% down below 2%. So if things are normal now, you would expect the 10-year Treasury yield to move back to a more normal level, which is closer to 3%. I mean, that's not really a high level by historical standards. So I think the market is just having trouble swallowing this medicine at the moment. And so if Treasury yields do move up, I think we'll have downward pressure on stocks over the next few months. I still think it's a correction within an uptrend. Haven't seen enough to change the long-term trend.
Mm-hmm. Well, we are out of time. Is there anything you would like to add before we go?
Yes, I think it's important if you're going to use an indicator that you understand exactly what that indicator is measuring. So look at the formula, even if it's a little bit complicated, but try to understand it. You can go to stockcharts.com. We have a wonderful chart school. I've written most of the articles, and they detail the indicators. So if you're using stochastic oscillator, learn what it is telling you so you know what price action is required to make it move. And that'll help you use it a lot better.
Thank you for your time today, Arthur. Today's guest has been Arthur Hill, and that concludes today's MTA podcast. From LexingtonCapitalLLC.com, I'm Lance McDonald, together with recording engineer Shane Skwarek at the MTA, reminding you that price is always right.